Good morning and welcome to this Monday, August 16th, 2021 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes featuring everything you need to know as you prepare for the trading day ahead and the trading week. Of course, we got options expiring this Friday, so that'll be something we'll be talking about more and more as the week progresses. Of course, we have our Max Pain event on Tuesday. We always do that the Tuesday before Friday options expire. So that will be tomorrow night, and that is for Earnings Beats members only. But we actually have a free event tonight. So would love to have you stop by if you're not doing anything around 4:30 this afternoon. That's 4:30 Eastern. Would love to have you. We are going to be looking at the selection process of our portfolios. So we do what's called a sneak preview of our top 10 stock picks. And so I'm going to go ahead and take you over to Earnings Beats so you can see that. But if you go to our homepage, earningsbeats.com, you will see this notice here right at the beginning, front page, front and center. But it's basically inviting anyone to join. So if you'd like to come in, normally we open the room within about 30 minutes of the webinar starting. So webinar start time is 4:30. So we'll have the room open around 4 o'clock. You can come on in. We won't get started until 4:30, but the room will be open. If you are not currently an Earnings Beats Digest subscriber, which is our free newsletter, and you come into the event, we will add you. You can unsubscribe at any time. There's no cost, no credit card required. It's completely free. I think you'll enjoy it. But just want to let you know, those who come in, we do want to make sure that you're part of our community. Also, one of the keys to being a subscriber of our free newsletter is that when the webinar is over, we'll send out recordings to everyone on our list. So that's another reason that you would want to be a subscriber. If you just want to subscribe directly, you can just scroll down on our homepage. You can kind of find the spot here. It's, again, completely free. It's published 3 times a week, Mondays, Wednesdays, and Fridays. Simply type in your name, email address, hit that subscribe button, and we'll make sure you get set up. But should be a good event. These portfolio selection webinars and the sneak previews are always great events. Because we go into a lot of detail about not only how we pick them, but some of the themes that are emerging in the market. Now this year, and really for the past, I'm going to say almost 12 months, probably since the positive vaccine news came out back, I think it was November 8th or November 9th of last year. The rotation has been crazy, and there's always rotation, but the rotation since November has really been hard to peg down because it's been so rapid, and we just keep seeing the movement back and forth. Normal rotation lasts through cycles, and this is not. So that's made it much more difficult, I think, from an individual stock selection standpoint, especially if you're looking to buy and hold for a period of time. Long term, just stay in this market. Market's been crazy. It's been on fire, but more intermediate term, short term, I'm talking about maybe 3 to 6 weeks. Very difficult to try to predict exactly what the market's going to do. And we are in August and September. I mean, we're now, heading into the second half of August. This is the second half of the calendar quarter that started July 1st, runs through September 30th. I've written plenty of articles talking about how the second half of a calendar quarter is not nearly as good as the first half of a calendar quarter. First half, you got a lot of earnings related advances. You get pre-earnings advance. You get the numbers coming out. Some companies jumping after the earnings. Once we get to the end of earnings season, the market quiets down and it makes it more difficult. There's no reason for prices to be going higher. And if anything, I think prices tend to drift a little bit lower so that institutions can get prices, get their stocks cheaper before we start the next cycle of pre-earnings runs and so forth. Anyhow, let's go ahead and move on, take a look at what is going on or what happened in the market on Friday as we closed out last week. We saw the Dow Jones Industrial Average finish up 15 points. It was kind of a ho-hum session. Lack of volatility is definitely one way to describe it. You can see the candlestick, not very big. Look at the S&P 500. It's almost like it just opened it up 7 and closed there. I mean, very, very little movement during the day, but it did set a new record. The NASDAQ, no records, but we were up 6 points. Again, not a whole lot of volume. Mid caps and small caps definitely hit the hardest. Mid caps down almost 1/4%. Small caps down almost 3/4%. But all of the major indices, in my opinion, still remain pretty solid. Small caps may be under a little bit more pressure on a relative basis. You can see their AD line's been a little weaker down here at the bottom, whereas all the others essentially are going to new highs. And then also you can see the price action below the 50-day, still above the 20-day, but straddling with the 20-day below the 50, by the way. We've seen the golden cross on the mid caps where the 20s come back up above the 50. And we've been, pretty much in that same configuration with the 20 over the 50 on our key indices most of the last couple of months here. Moving on to the individual sectors. It was more a defensive day on Friday. Again, there wasn't much volatility. There wasn't a whole lot of buying, and where there was buying, it seemed to be in the defensive areas. Consumer staples up about 4/5%, 0.83%. The utilities up 0.7%. You can see both these groups strengthening. Real estate still strong, although negative divergence here. I'm a little bit more nervous about real estate right now because of that pretty nasty negative divergence, but it did manage to move higher off the 20-day on Friday, gained about 2/3%. And then finally, healthcare. Healthcare pretty strong. Each one of these pullbacks to the 20-day has been met with buyers. We saw that again Thursday and Friday of last week. PPO looks pretty good. Now, some might look at that PPO and say, well, yeah, but you got the cross below the trigger line. That's not how I look at the PPO. I'm more of a swing trader. And so I actually look for pullbacks to the 20-day, and pulling back to the 20-day normally will get you that cross. What I look at is where was the PPO on the most recent high and where was the PPO on the prior high. And so if you look at these highs coming up here and you look at the PPO, you can see momentum is building with each high. That normally means I want to be considering that area, in this case, this ETF, when it hits the 20-day moving average. And I'll talk a little bit more about individual stocks and the strategy in just a bit. Steel was one of the better performers on, well, really all last week. I mean, you can see steel did extremely well here, moving up throughout last week. It did finish slightly higher on Friday, but really I just wanted to point out this move that steel made last week, very strong. All right, moving on to the 10-year Treasury yield. Let's get an update. I don't like I should say I don't like what's going on in the sense that we came back down and failed to hold 130. I like what's going on in that rates are remaining very low, which I think ultimately is going to play perfectly into the growth story. I also like the fact that even though we got past 2 more inflation reports last week, that here come the yields down again, meaning money is rotating into treasuries. You would not buy treasuries if you thought inflation was going to be a big problem. I mean, that's the last thing you want to do, is just be into a treasury that's yielding 1.26% and then have inflation eat away at it. If inflation starts picking up, you're losing money by being in bonds. So I like the fact that it's moving down. What I don't like is the fact that it's hard to differentiate. Okay, I'm pretty comfortable that inflation market is not seeing inflation as a problem. If inflation was a problem, I don't think you would be seeing the yields doing this for the last 4 or 5 months while the big inflation reports have been coming out. So that to me is a good sign that the market does not believe that inflation will be a problem, which is exactly what the Fed's been telling us, that any inflation issues will be transitory, meaning temporary. But I think the economy is going to be strong. So I'd kind of like to see the 10-year Treasury yield move up a little bit, and maybe even go back up and threaten those highs from back in March just because of the economy. But maybe what we're going to see is the economy strengthen and no inflation, and as a result, interest rates stay low. And if that's the case, we could be seeing a massive rally in the stock market by the end of this year. Now, I've said before, and I'm going to stick to it, I think next year might be a little troublesome. We're going to have to talk about it a little bit more. Once we get into earnings season, I think maybe the January, February timeframe, we're going to want to kind of be watching the market, because if it does strengthen, as it normally does from November through the middle part of January, there's a lot of history that tells us that's likely to happen again. I think after that mid-January period, we're going to want to, kind of keep our radar up, because it's going to be difficult for companies to meet and certainly to beat some of the comps from this year. And even if they're beating, they may not be beating at the same growth rate. And that could be a problem for the market. So it's just some things that I'm thinking about that are out there on the horizon. I'm not worried about it today, but it is something that, we need to keep in mind as we move forward, especially if we get the kind of fourth quarter that we may get, especially if inflation starts to come back down again and rates stay low. I think we're going to continue to have strength in the economy. The Delta variant with COVID, obviously that's one little variable out there. We got to keep an eye on it. But we'll just see. Right now, the market, I don't think, seems to be overly concerned with it. And if the market's not concerned with it, I'm not going to be concerned with it, but we do want to continue to watch it. All right, let's move on to talking technically. And I thought what we would do here is take a look. I mentioned last week, and I wrote in Chart Watcher's article over the weekend, that I thought, industrials could be the next group for rotation. And the reason I'm saying that, number one, we do see rotation go in and out of the aggressive groups in the market. And with aggressive, I'm talking about technology. I'll pull up the relative strength chart here. So here was technology. You can kind of see we had a rough few months, but then technology came roaring back. Consumer discretionary still is struggling, but we've seen periods, pockets of strength where we have sell-offs on a relative basis, then we recover. Sell-offs, then we recover. Right now, we're in a sell-off here. I wouldn't be surprised to see consumer discretionary finish the year stronger. We'll wait and see on that. Communication services been strong throughout, but we did have one rough period here, and then for the most part, we've continued moving higher. And then we've got financials, of course, with the yields moving up recently, seeing the financials after struggling, bouncing back with the yield. So that's been a good thing. And then there's the industrials. And when I'm looking at the industrials, I see a group clearly that for the last 2 or 3 months has been under pressure on a relative basis. But we saw that for about 2.5 months back at the end of 2020 into early 2021. And then you see what happened. We rallied back to new highs. Now we've been struggling again for a couple months, 2.5, 3 months. And what I'm looking at here is the possibility of a channel. Oops, that's not what I wanted. So if we just look at the recent highs and connect the highs here, these are relative highs. So that's connecting the recent highs. And if I take this and I drag this down, we're just a little below. And I think if we did a candlestick, probably could justify it here. But we're just a little bit below where I would be looking for this channel support to hold. So it may end up that we have to go down here. But we started to turn at the end of last week. I'm going to see if it continues. I mean, if we keep going back down, then obviously the next level that we want to watch for is relative support, which would be all the way down at that recent low. So there's no guarantee. And in fact, as I'll show you on a seasonality chart in a minute, September and November are very strong months historically for industrials. Well, we're not in September yet. So we're in August. We still got a couple more weeks. So maybe this channel doesn't develop. Let's get rid of that line. And maybe we turn back down again this week. Well, as we get closer and closer to this level, I would really become more and more interested in the industrials, because then on a relative basis, first of all, if we look at, and I'll pull up an absolute chart in a minute, but here's the absolute chart. I mean, we went up, almost got like a little bit of a cup. If we fail here and go back down, maybe we'll have an ascending triangle. Maybe we'll have rectangular consolidation. But if we see relative weakness, I think it's going to still set up fine on the absolute chart. So I wouldn't worry too much about it. It's just a question of, are we bouncing here? Do we go all the way back down to this support level? Those are a couple of things maybe to be watching for over these next couple of weeks as we close out August. But let me show you seasonality for the XLI. And actually, before I do that, let me pull up the S&P 500 and let's go back and do a monthly. We're going to go back even further than this. Let's go back. Let's go 25 years. So on the S&P 500, we went through this secular bear market. So this was from 2000. We didn't clear secular bear market territory until 2013, right here when we cleared these prior two tops. That's when we could definitively say the bear market was in the rearview mirror. Now, a lot of folks, I mean, using hindsight, you can go back and say the bull market started in 2009. But, you know, if you had made the same assumption back in 2003, well, heck, we bottomed, we're going higher. Look at what happened. So there's no guarantee we were going to go up here and break out. So yeah, now looking back, Monday morning quarterbacking, we can say the bull market started in 2009. But for me, the secular bull market doesn't begin until we get this breakout. So 2013 was the year. And I bring that up because I want to see how these various areas have done. When I look at seasonality, I want to see what they're doing in a secular bull market. So when I go into the seasonality on the XLI, I go back and I look at 9 years. When I pull up 9 years, you'll see here, this is when it talks about the XLI from 2013 to 2021. So this gives us the period of performance over the last 9 years, September, October, November. Now, when you look across here, you might look at it and say, well, September, you know, it's 63% up, 1.4%. That's not that great. But you have to understand that September is the worst month of the year for the S&P 500. October actually, you know, kind of looks similar, although it, you know, gains a little less. But this on a relative basis is actually worse because October on the S&P does pretty well. And then November, you can just see is strong. But I want to change this. I'm going to compare the XLI to the S&P 500 and then pull that back 9 years. Look at September and November. Both of these calendar months, industrials have outperformed the S&P 500 every year during the last 9 years in September and in November. And the outperformance, I mean, when you look at it relative to all the other months, I mean, February was pretty good at 1.3%, but nothing else is even over 1%. September 1.6 and November 2.2. So 2 of the next 3 months, very strong for industrials. And October is just kind of a wash. You know, it's 50-50, whether it outperforms or underperforms, and it averages a slight underperformance. So if you group these 3 months together, these next 3 months are the 3 best months for industrials. And August actually goes up 2/3 of the time and a slight outperformance of the S&P. So it seems like things start to kick into gear in August and then really begin to go September through November. Now, history doesn't guarantee us anything. I'm not saying that this guarantees us that industrials are going to go higher and they're going to outperform. It's going to be a love fest. I'm not saying that at all. I'm just pointing out history. The market does repeat itself from a historical perspective in many instances. And I think it's worthwhile at least being aware, because if industrials break out, and let's now take a look at the chart on the XLI. If industrials break out, we've been going sideways here now for the last 3 months. This is why the relative strength has been bad. Absolute performance is not bad. This is an uptrend followed by sideways consolidation, rectangular consolidation. If we annotate, I would just get this support and resistance line. Okay, can't get through about 106. We're sitting at 105, and we've been holding 99 and a quarter. So sideways consolidation, rectangular consolidation after an uptrend. You could even call this a lengthy flag. You know, you got the flagpole going up. Here's the flag. That's a bullish. This is a bullish pattern, no matter how you slice it. So eventually, I'm looking for this to break out. When it does break out, you need to be aware of the seasonal tendencies because these next 3 months are very strong. So it's not that I would just jump into the XLI because seasonality tells me so. I would just want to be aware of it so that if I get a technical breakout, or if this group is weak, let's say the market weakens through September like it normally does, there's nothing saying industrials won't go down when the market goes down. It just has been outperforming. So what if the S&P drops 5% and industrials drop 4%? I mean, we still have that same seasonal pattern in play. Industrials outperformed. Doesn't mean they went up. So again, you have to be careful as to how you read and interpret this information. I'm not saying industrials are going to go up. I'm not even saying that the industrials are guaranteed to beat the S&P. I'm just saying seasonally, that's been the case. All right, so if industrials do well, had a couple members ask about, what do I think about various areas of industrials? So I thought maybe what we would do is go through our relative strength industry group charts with the industrials and just take a look at what's strengthening and what's weakening. And won't have time to do it here, but you could always take these groups and look at them on a seasonal basis, as I just did with the industrials, and see how they perform. But here's the waste and disposal services. So it was rough for close to a year, but it has begun to strengthen here in 2021. Another breakout above that high in May is what I would be looking for. Trucking's been picking up, but trucking has been so volatile. I mean, this is kind of what I was talking about earlier, when the volatility, the rotation in the market has been so difficult. It's like for 3 or 4 months, you didn't want to touch truckers. The next 3 or 4 months, you wanted to make sure you're in truckers. And then for the next 3 months, 2.5 months, you wish you never touched them again. And now they're starting to rally back. So it's just been this constant flow that's made the market really hard. So truckers definitely are strengthening, and just be careful if they begin to roll over. And if you look, many of these groups that look so crazy on the relative chart don't really look that crazy on an absolute chart. So what you're really looking for is when a group begins to consolidate, get away from it. When you see consolidation and you don't see breakouts, then I would get out. When you got a group that's breaking out and moving higher from a momentum perspective, that's when I would be getting in. When we talk about this later tonight with the sneak preview, the problem is we hold those stocks 90 days. So from a trading perspective, it's much more difficult. Well, from a trading perspective, it's less difficult. But in the portfolios, because we're holding 90 days, if we go in to May and it's a selection period and we see that truckers are strong and we get into a trucker and we hold for 90 days, look what happens. That's the problem right now with anything to do with the portfolios, is you just don't know which areas are going to lead and for how long. But we'll talk about more about that later tonight. But anyway, truckers definitely strengthening. But can they make this breakout? So yeah, they're strengthening here while we're moving up to resistance. But if we make the breakout, I think you're going to see this continue. If we fail, then we're talking about more consolidation, and you'll probably see this roll back over again. All right, business support services. This one's been a pretty good group for the last 4 or 5 months. Nice little trend line there. It's definitely in breakout mode. So this is a group that's fine. Diversified industrials, got to be careful here. Well, we're just, if you see a reversal and we fail to hold this breakout, which looks like we barely broke out the end of last week, you can see relative strength didn't really pick up. So if we fail here, be careful if this relative strength breaks down below that support area. All right, industrial suppliers, been weak of late, but is this absolute chart weak? No. Industrial suppliers is fine. It's just set a high, set a low, and now we're in this phase where we're just sideways consolidating. Defense. I thought defense was coming back, starting to come back a little bit beginning of the year, but look how rapidly this group has deteriorated again. And it's one of the few groups that when you look at where it is now and then look at it pre-pandemic, it's still not even close. We still need another 10% or so just to get back to our pre-pandemic level. Meanwhile, the S&P 500 is probably up 40% or more from its pre-pandemic level. So that's what's driving this relative weakness here. So defense groups or defense stocks, I would definitely be careful with. Now, one group that I think is starting to turn back around is the heavy construction group. Here was the relative strength, and here's your 2 or 3 months of relative weakness, relative PPO back to the center line. It looks like maybe we've broken this downtrend line and starting to turn back up again. Now, if it continues and we get near this high, that's when I'd grow more cautious. But really looking at these charts, again, it's about pitting both of these together and against one another, looking at the relative chart, but also looking at that absolute chart. Transportation services, I love this relative breakout right here. And look at what happened. Do you see how this breakout occurred right after we got this price breakout? That's what I'm talking about. I think transportation services looks really good right now. I would say it's one of the stronger areas in the industrials. Industrial machinery, starting to turn back up again. It did just break out. So this is a group that's strengthening on an absolute basis. So we should probably be expecting it to continue on a relative basis. Railroads, like the truckers, went through a horrible period. And I was talking about, transportation stocks not doing well, really needing to see them go higher. Well, as bad as they look on a relative chart with this huge drop, if you look at the, we broke out above 31.40 or so. We never lost that support level. Now railroads starting to turn back up again. So I think railroads are an area that will probably continue to strengthen. Marine transportation, not liking the relative weakness here. This is another one like the defense group, way, way below where we were pre-pandemic. So it's a group that I would tend to stay away from. Building materials and fixtures on a relative basis, looks like we're probably going to break out. We've already gotten the breakout on the absolute basis. So as we get up here, watch for a reversing candle on the daily chart of building materials and fixtures, the absolute chart. Because if we get a reversal here, that could signal relative consolidation. And it could be just be, I'm looking back here to January. See how we were moving up, getting close to that prior high, and then we turned back down, even if it's just for a week or two. I'd be careful. I'd want to see both of these, like we saw with transportation services, get this breakout and then get this breakout. Then I think you've got something. Aerospace, not very good. Again, not able to get up past that pre-pandemic level, rolling over. Still, the uptrend off of the lows remains in play, but this has just been a much weaker group, like defense. So I would stay away. Commercial vehicles and trucks, been very weak, but also realized how strong it was for a year on a relative basis. So the group, money just rotated out of it for a while. It's starting to turn higher, and it also could be turning back up to go challenge that 3,600 level. So I actually like this group in the short term. Now, if it gets back up close to 3,600, you're going to want to be careful there. All right. Delivery services, pulling back both on an absolute and relative basis. Watch maybe this 1,500 level. If we were to drop a little further, I think that's where we could find support. I'm not sure we get back down that far. I'm just saying if we get down there, I'd watch for that. Also, this relative support area. But this is another perfect example of a stock or a group that was going higher on an absolute basis. Look what happened when we hit relative resistance. So right as we hit relative resistance, we got the sell-off. Airlines, not interested. Now, this is again part of the transportation group. I'm not as fond. You can see on a absolute basis below the pre-pandemic levels. Stocks in areas that haven't gotten back to that pre-pandemic level, that should just be common sense that they are really poor relative performers, because the S&P has blown that away. Most areas of the market have blown that away. So if you're investing in groups that still have not even gotten back to the pre-pandemic levels, I just don't like their performance, and relative performance starting to drop again on those airlines. Property and casualty insurance, on a relative basis, back down near lows. So I'd probably be a little careful here. We are still, moving in an uptrend, so that's good. But as we get closer to that relative high, I think I'd be a little careful. I think I said relative high. Down here, as we get closer to that absolute high, absolute high, I'd be careful because relative strength just hasn't been there. This has not been one of the better groups. Anyway, we're now into the financials. I don't want to go through all the financials. It's 9:30 markets opening. I do want to mention, though, earnings, got a number of earnings coming up this week. Later this week, we're going to get NVIDIA, Cisco, Lowe's, Target, Keysight Technology. This one, by the way, Deere, a very nice performer relative to its peer group. So the peer group hasn't gotten back up to where it was 3 months ago, but Deere relative to its group is broken out. So Deere does remain a leader in this group. I expect a good report from Deere. They'll report on Friday. But Keysight Technology, I want to pull up. They'll be reporting on Wednesday. I mean, the AD line started to strengthen. Price is broken out. This is a stock relative to its peers that it has been performing pretty well over the last 2.5 months. So I just think this is a stock that I'm expecting good numbers from. And the market's expecting good numbers from a lot of these stocks. NVIDIA up again today, AD line breaking out. I mean, if you look at it relative to its peers, it set a relative high back in beginning of July. We'll see if we get a breakout with NVIDIA. A lot of good news is built in here. They're going to have a good report. You can't be 100% certain, but I believe NVIDIA is going to blow the numbers out of the water. That's my opinion. Does that mean it's going to go higher in price? No. And that's the problem with earnings, because so much has already been built in. What you want to be careful of with NVIDIA is a big gap up. In fact, if it gapped up, I would probably sell at the open. Just because it's already come up so much, it could be the last final gasp until it goes into more consolidation. We could see another move back down to 180. We'll just have to see how it trades. I'm just pointing out, in my experience, you got to be careful with these companies that make big moves, have blowout reports, gap up, and then that's it for a while. So my experience, if you get a gap up and I owned it, I'd probably take the money and run. And then Thursday we got Applied Materials coming out, big report there in the semis as well. But not a whole lot going on after this week. So we get into the latter part of the week, we got a few more big companies, and then the earnings will really be slowing down. Of course, Thursday after the bell is when we'll have our draft for our portfolios. We do that after we get most of the key earnings reports in for the quarter. That's why we always time it for about the 19th of the second month of a calendar quarter. So it's always February 19th, May 19th, August 19th, November 19th. That's always going to be our draft, because we're waiting for all of the earnings to come in and see where the leadership is at that point. All right. Well, 3 you must see. Let's do 3 of these earnings reports. Start off with Lowe's. So Lowe's will be reporting on Wednesday, and Lowe's is kind of weakened here. So home improvement's gone down, but it started to come back up. And while the group's been coming up, I don't know, it looks like Lowe's is starting to roll back over. So look at the relative strength of Lowe's versus its peers. Really weakening here. So I think you got to be careful. AD line down near a 52-week low, or at least, 52-week low. So I think you got to be careful with Lowe's going into earnings. Target, among the broadline retail group, this has been one of the better performers. Here's the relative strength of Target versus broadline retail. So while Amazon's been struggling and been consolidating and weakening, Target just is eating their lunch right now. AD line moving up, price action's been great. So Target, I would expect a really good report. Now, again, it could be a sell-off, it could be a buy on rumor, sell on news. And that's why I always say earnings are the most, the riskiest time to own a stock, because you can have great news with earnings and still go down. It's just hard to guess exactly which way the market's going to go. I can feel pretty strong, and I do feel very strong. Target is going to have a blowout report. Are they going to gap up though with earnings? Probably, I'm going to guess, but no guarantee. And then the last one, I'll show you. How about the synopsis? SNPS. Here's a stock getting up close to that resistance from back in February. AD line's been strengthening, but synopsis relative to software has not really been a great performer. I mean, software's taken off. So software, and this is relative to the S&P 500. I mean, if you look up here, software's broken out, easily cleared highs from back in February and April. And yet the February high still stands for synopsis. So things are improving, but we're probably going to find out later this week. They also report on Wednesday, along with Target and Lowe's and NVIDIA and Cisco and those companies. They all report on Wednesday, but we're going to find out whether or not that's the catalyst to get things started here. All right, let's get a quick update. We're 5 minutes in on the market. Right now, Dow Jones down 217 points, S&P down 20, NASDAQ down 52. Not a particularly good start to the week. I know there was some news out of China, growth not what was expected. I'd be careful about following too much what's going on in China. I've shown charts before. The U.S. stock market and the China stock market are about as inversely correlated as any two major global index. As we look around the world, the U.S. tends to follow Germany much closer. Even the Nikkei and the Hang Seng, the U.S. follows those two indices much closer than it does the Shanghai. So I know sometimes the Chinese data gets headlines here in the U.S., but honestly, there's normally not a whole lot of correlation between the two countries. So I'd be a little careful reading too much into that. I'd be personally more concerned about what's going on over in Afghanistan and, the turmoil there and what may happen, that's an area of the world that we've always got to be careful about with all the oil and so forth. We don't know, but if this continues to escalate, I would see that as more of a threat short term to the market than what's going on over in China. All right. Anyway, that's it for me. Appreciate everybody tuning in. Remember, later today, go over to Earnings Beats, 4:00. You can come into the room. Here's a link. Of course, if you try to click on the link now, it's not going to work. So don't send us an email saying the room's not working. It's not going to open until 4:00. But anytime after 4:00, come on over, click on it. We'd love to have you. Talk a little bit about what's going on in the market, the themes that I'm seeing, and some of the things that we'll be talking about that'll lead up to the Thursday draft of the portfolio stocks. All right, everybody have a great day. I'll be back over at Stock Charts TV tomorrow morning at 9 a.m. Eastern for your next Trading Places Live. Of course, that'll be a recorded version. But all you have to do at Stock Charts is just go over here and click on Stock Charts TV at 9 a.m. and you'll be able to listen to the show. Everybody have a great day. Happy trading.